The earnings season for India kicked off as Infosys and Tata Consultancy Services released their Q3 results yesterday. Now let's delve into how these two tech giants performed across key parameters in the third quarter. Starting with revenue. TCS revenues grew 1.5% quarter-over-quarter and 4.5% year-over-year, reaching ₹606 million. Now, in contrast, Infosys witnessed a slight dip in revenues, down by about 0.4% sequentially, but saw a growth of 1.3% year-over-year. Now, for both companies, we see year-over-year revenue growth rate is on a declining trend across last 7 quarters. Now, looking at geography and vertical performance. TCS heavily depends on North America, which experienced decline in revenue growth, but the UK and India stood out with 8% and 23.4% growth respectively. On the other side, Infosys too heavily depends on North America, where revenue took a hit, declining about 5% year-over-year. Now, the sluggish performance in America for both these companies isn't very surprising considering the macroeconomic situation in these regions. Now, moving on to vertical performance. For Infosys, major sectors like financials, communications, and high-tech faced decline, but manufacturing, life sciences, and energy utilities showed resilience. Now, TCS had a similar story with banking and financial services, communication, and technology witnessing a year-over-year growth decline, while manufacturing, life sciences, and energy utilities showing improvement. Now, coming to operational performance. TCS showed a strong operational performance in Q3 with its EBIT margin growing by 70 basis points sequentially to 25%. Now, this growth was on the back of improved execution and operating efficiency. However, Infosys faced a 70 basis points decline in profitability, settling at 20.5%, mainly due to the impact of wage hikes and furloughs. Now, both TCS and Infosys experienced a slowdown in deal wins during the December quarter. TCS secured deals worth $8.1 billion, a decrease from the $11.2 billion in the previous quarter. Meanwhile, Infosys bagged deals totaling $3.2 billion in Q3, less than half of its September quarter wins. Attrition rates saw a decline for both companies, with Infosys at 12.9% in the December quarter, down from 14.6% in the September quarter, and TCS at 13.3%, down from 14.9% a quarter ago. Now, coming to the guidance. Now, TCS traditionally doesn't provide guidance, but Infosys does. Infosys management adjusted its fiscal year 24 revenue growth guidance to 1.5% to 2%, down from the earlier guidance of 1% to 2.5%. Now, this adjustment is mostly due to near-term demand concerns. However, despite the cut in growth guidance, the Infosys maintained its margin guidance of 20% to 22% for fiscal year 24. Now, coming to key takeaways. Now, the recent quarterly performance of IT companies have shown healthy figures and in line with estimates, with no negative surprises in the numbers as such. But the near-term demand environment remains challenging as clients exercise caution due to uncertainties in the macroeconomic situations in the US and Europe. Now, despite the strong growth witnessed in the US economy throughout 2023, the risk of a slowdown in 2024 cannot be dismissed given the substantial rate hikes undertaken by the Federal Reserve. However, the companies with a diverse range of competencies are expected to weather the economic slump better. Now, while tough times are anticipated for the IT sector in the near term, it's worth noting that the industry has weathered numerous turbulence periods before. Now, the long-term growth story of the Indian IT sector is expected to withstand minor impacts. Going forward, these are the key metrics to track. Paying attention to commentary on the deal pipeline and any signs of slowdown, delay, or cancellation in deals. We must also look at revenue growth of top clients and core verticals and keep an eye on the margin outlook. Now, along with these, hiring momentum and attrition rate trends is another factor we should keep an eye on. Having said that, this is me, Merlin Zana, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com